Right.
Yeah. Surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the moe, all the Mars on deck.
All right, what's going on, everyone? Welcome. Good evening. Right, okay, so today's been a bit of a mad day for me personally. I've been all over the place today and catching up on the inflation news. I caught it this morning and I've just been catching up through the day. But that's what we're going to talk about today, this evening. Inflation is flat at 6.7%. I think if you spent time with me covering this on the channel, we've missed our Q3 target by a long while. And, not even close. The target for Q3 was 5.8%. We're at, October, September's figure, keeping it level at 6.7%, which is still far beyond where it needs to be at 2%. So what I want to do is I want to start this live by just looking at some of the comments from from Andrew Bailey, who is the boss at the Bank of England, just to remind ourselves of, kind of what the sentiment is and what the actual goal for this is, because they've been on the record to say that they were going to do what is necessary. I feel as though they're kind of like backpedaling a little bit now. So here's just a few comments from Andrew Bailey I just wanted to share, because I think that it's really important in terms of some of the things that he said and how he goes about saying them as well.
More than we expected, and that's very good. But of course, the job's not done yet. We can't be complacent about this. Our job is to get inflation back down to the 2% target and to sustain it there. So the job isn't done yet. And we will, of course, keep on doing the job.
But many people see this now as a peak. We've seen other central banks also sort of pause their rate rise cycle. Is that the right way to look at this? The next move will be down.
No, I'm not predicting at all what that is. I can tell you that we have not had any discussion on the Monetary Policy Committee about reducing rates, because that would be very, very premature. Our job is to get inflation down. As I see it, we've got a big job to do. We've got quite a long way to go yet. It's encouraging, but I'm afraid we can't be complacent. And of course, we will watch the evidence very carefully, as we always do.
Okay, so what he's referring to there, let me just go full screen really quickly so I can get you guys in on me. Interest rates. Because when I look at this, and I think when most people will look at this now, if you think about the track record, if you think about what they've been doing thus far, inflation's been high. They've been out. They said we're going to be bullish with interest rates. We're going to push as far as we need to before we break something. But we'll do what is necessary in order to bring down inflation using interest rates. So now we're at this juncture where, if you look at one of the graphs, which I've actually got here, which I'll show you a little bit later on, back in October, we were at 11.1%. We saw the interest rates continue to go up. We are now kind of, back down to 6.7%. And this isn't to say we haven't made any progress. We have made progress. But the key question is, if in October last year, we were at 11.1%, and right now we're at 6.7%, yes, that's progress, but it's still a way away from the 2% target. Now, the question is, what are they going to do around interest rates? That's going to be the biggest question that a lot of people are going to have. And ironically, I literally just had a letter in the post today from my mortgage provider telling me that my mortgage is going to be going up at the end of this week. Many people will be receiving that right now, today, this week. And the thing that we don't know just yet, and we'll have a look at the forecasts on trading economics in a moment, we don't know what they're going to do with interest rates. And they're in a quarry right now. They've got a real conundrum. If they continue to push interest rates, obviously that's going to have an impact on mortgages. It's going to have an impact on rents. It's also going to squeeze even more so households. We already know that given the interest rates that we've seen, it's been almost 2 years now since we started this. With the interest rates that we've seen, in mortgage territory alone, the average increase that will start to come home to roost from now all the way through 2024 is about 500 quid a month. That's on average across the UK. Most households are not going to be able to find an extra 500 quid a month just to cover the mortgage payment. So they're in a bit of a bind. Do they, because inflation is now flat, it hasn't budged, do they then say, actually, you know what, let's push interest rates even further? I was speaking to some people earlier today. I was in London today, actually. And I guess in the city, I'm being told that the sentiment is that they're going to hold on interest rates next month. So they're going to hold at 5.25%. And it's interesting because I'm just going to show you this graphic right here, which we've referred to this quite a bit on the channel as we've kind of tried to cover a lot of this over the past couple of years, 8 months or so. I want to show you this one. Oh, 1 second. I'm just getting it off. Pressing wrong buttons here. Guys, I'm really not with it today. I've got a headache. I've had a headache all day. I don't know why. I've taken some paracetamol, I've taken some painkillers, but it's been one of them days. Let's put it that way. My train had a massive delay, which put me out. I had to do radio this afternoon, and it was everything was razor thin when I thought I had like a couple of hours kind of a buffer, but I just don't. Anyway, right. So let's have a look at the forecast. We've referenced this quite a bit this year following this whole saga. Now, if you do remember, you might have to go back on some of the previous videos we've done talking about this. In Q3, we were supposed to be at 5.8% in terms of our inflation rate. At the moment, this is where we are, 6.7%. And this is the forecast for Q4. So 4.5% is what they're actually forecasting. Now, they are saying that we're going to see some positive headwinds, so some positive influences to bring down inflation by way of energy costs, so on and so forth. But at the moment, there is about a 70% chance the city's betting on that they're going to keep interest rates level next month when the Monetary Policy Committee meet. Now, this is the forecast for interest rates. And this has been pretty accurate, I would say, over the past maybe 6, 7, 8 months that we've been looking at this. It's been pretty accurate, apart from maybe 1 or 2 where actually they didn't move. But a lot of the time, a lot of the forecasts in there have been spot on. I think we were expecting that the last meeting, this was going to jump to 5.5%, and it didn't. So this is the forecast. What we're seeing is, well, interest rates will be flat. So no further interest rate rises through Q4, Q1, Q2, and Q3 of 2024. So this is where, they're in a bind. Is there enough pressure, given the interest rate rises that have come before now? Do they create enough pressure to bring down inflation? I don't know. But I guarantee you they're going to be hoping that that is the case. And actually, Andrew Bailey kind of alluded to this in a segment of his talk here. And I'm going to play this because we might get to it in a moment, just so you can hear what he had to say.
Is your sense that the medicine is now working?
Yes, I think the effects of what we have done over the last, not far off 2 years now, actually, are coming through. We've used the word restrictive. What I mean by that is we can see policy having effects. We can see it, in a sense, having the effects we hoped it would. And that, of course, is reducing the inflationary pressure in the economy.
Are you worried about maybe what's happening in the oil market with fuel prices? The IMF have done a report saying, beware premature celebration. We've looked at the 1970s oil shock. That's what happened then.
Well, there's no premature celebration because we've got a long way to go. Yes, we are watching the oil market very carefully. I think that's important. We have to do that sort of thing. We also have to be very careful in the judgments we reach on it as to how permanent it's going to be, what the effects on the economy are going to be from it. So we watch it very carefully.
And we are a year.
The point on oil is a really interesting one, because if you look back over oil prices from October last year, I think it was $72 a barrel this time last year. It's now $92. And we saw a bit of a price jump in oil, certainly over the last month. Has that come through just yet? I mean, when you look at the way Sky have been reporting this morning, what they're saying, and let me just share this with you. Get this on here and go here. Inflation is stuck at 6.7% as petrol goes up. So that's been the main contributing factor. Now, a lot of people might be a little bit concerned about what's happening with Israel, Gaza, um, that side of the world, you know. And look, it's had a lot of coverage. The fear is if the likes of Iran, Saudi Arabia get into this conflict, potentially that has an impact on oil prices, because all it will take is for one of them to say, you know what, we're going to either reduce oil production, and that's going to kick up the price of oil. This is going to then come and impact us here. So whenever you have a conflict, it's never good anyway, regardless of where it is in the world. But particularly when you're going to have people like Iran and Saudi Arabia potentially coming into the foray, that can lead to a lot of uncertainty, and markets don't like uncertainty. Economies don't like uncertainty. So this is definitely a bit of a concern right now. But the question is, what are they going to do? Honestly, I have no idea. I'd love to know in the chat, what do you think they're going to do? Do you think that there is merit in pushing interest rates up even further and sticking with the pain that that is going to cause? I mean, I think where they are at the moment, and whether they were bluffing or not, I guess we're gonna have to wait and find out. I'm just trying to find this tab again so I can show you this. Go back onto here. Whether they've been bluffing this entire time and using the right language just for, I guess, appearance, political posture, posturing from an economic point of view. Whether that's all just been bluster, I don't know. But they're in a very, very, very difficult situation right now. You don't want to cause too much pain to households. That's for sure. You don't want to. They don't want to. But also, you don't want to cause damage to the economy, because we're going to need business to do well. And if business does well, you can keep the unemployment number low. You can have profits from businesses, but businesses need to invest into their business. So if you keep interest rates, the borrowing cost high, well, you're making it more difficult for businesses to invest, which may pop up the unemployment numbers, right? So it's a really, really tough call that they're going to have to make next month. What we are hearing higher interest rates for longer. And if you look at this right here, this is basically what this picture is painting. 5.25% consistently. In some circles, people are still saying that we're going to have to get to 5.5%, 6%. Maybe this will change in the future, but it's going to be heavily dependent on whether this actually goes to plan or not. If anything, everything we've been tracking over the past 10 months, and I can't even believe we're saying that, 10 months we've been tracking this. This has been the column that has been just so uncertain. It's been wrong. It's been okay. It's been near on point. But let's just see what happens, I guess. But it's going to be very, very interesting indeed. The states are kind of signaling that they've kind of done enough when it comes to interest rates right now. They're about to kind of like pause. But their inflation position is so much better than ours. And I'm just going to see if I can actually find it here, actually, just to show you. Their inflation figure is completely different to ours. Let's have a look at forecast. I've never looked at it this way. There we go. This is their inflation rate, 3.7%. So they're closer to 2 than we are. And look, they're saying that this is forecasting that there's likely to be another increase in the Fed rate in Q4. And that's going to then mean that they pause for Q1 2024, then go down to 5.5% in Q2 and Q3 2024. Whereas at the moment, we're forecasting the latter. We're forecasting 5.25%. I don't really know how that is going to pan out. I don't see how they're going to be able to continue on this road without pushing interest rates. It's a very, very unpopular call to make. So we'll see what happens. Andrew Bailey said that they haven't discussed reducing interest rates just yet at any meaningful degree. But they're going to start to have those conversations at some point if things don't start going to plan. But anyway, I'm just going to get into the comments to see what you guys have to say, because I'm really fascinated to hear your views. I was going to do a poll, but to be honest, because I've been in such a rush today, I wasn't able to get a poll together. So let's see what you guys are saying in the comments right here. Zero, just a quick one. Thanks for accepting to sign my son's book. I really appreciate it. Smash the like button, people. Right, dude. Okay, so I've been looking at how I might be able to get to you. So one of the things that I thought about was, okay, because I'm in London quite a bit, whether I can actually sign it come to you, sign it. But if you send it to me, that might just be easier. Once it arrives, I'll sign it. I will send it back to you. So I appreciate you, mate. Thank you. Dylan, how you doing? Wonders here. Good evening. How you doing, mate? I did an amazing talk in London yesterday. I'm still on a bit of a high from it. It was amazing. It was really, really cool. It was a sold out crowd in the Curzon Soho, and it's the first time that I've done kind of like a talk. I've done a lot of stuff online, and I've done a few things in person, but this was one of the better ones that was really, really enjoyable. I've been on a high from that, and I've been looking at the footage and some of the pictures from it. I'm going to share some over the next couple of days or so, but it was just so cool to do a talk like that yesterday. It was for a podcast called Squiggly Careers. They've got 4 million downloads. They're huge, huge podcast. And to be asked to go on and talk about money and mindset, it was actually quite interesting. And it's weird because I did a talk on a farm 2 years ago, and the lady who owns the podcast was on the farm, and we didn't speak. And it's amazing that you don't know who's watching whenever you do stuff, which is why you should always put your best foot forward. Bit of a tangent, but I just wanted to share that because yesterday was a really, really good day. And I'm still on a bit of a high, despite the fact that I've had a bit of a rubbish day altogether. This isn't even taking into account inflation most of us feel daily, food and energy, which is much more than 6.7%, 100%. Yes. I mean, I don't know what the core inflation number is just yet. And that's something maybe to actually have a look at as well. I'll probably do that when we get round to the next Bank of England meeting to see what core inflation is and how they're going to inform their decision. But honestly, I think if you look at it with a silver lining, it's good that they're going to hold, or the consensus is that they will hold. It just means that there won't be any more pain for people with mortgages. And potentially with rents as well. I think if we saw further interest rate rises, what that would do to the property market, what that would do in terms of people not being able to pay their mortgage, repossessions, the wider impact it then has on the economy, that would just be too huge. So it's kind of good that they're pausing for thought here, but at the same time, we can't go on having inflation at this level. We just can't. It's not sustainable. So what are they going to do? This is why they're paid the big bucks. So let's just hope they're able to come up with some ideas. Again, the Bank of England didn't hit any KPI in terms of inflation. Who will be the first to be sacked? That's what would happen in the real world. Yes, that's very, very true. You know what, though? The only defense that they will give to that is that there are so many variables when it comes to inflation and economics globally that it's hard for you to be able to control or accurately predict what is going to happen. That would be the argument. Whereas in a business, you're in full control over the things that you do and the outcome, because if you're working in a marketplace, for example, you have a market position, you know your customers, you're doing research, you're doing all of these things. There are less external factors that influence the results that you potentially get. That doesn't mean that you can cover all your bases, no, but there are less variables involved in that equation. And therefore the decision as to whether someone is fired or stays in the job is a little bit more clear cut. It's really messed up, but I agree with you. Like, someone should take accountability for the fact that you've got this so wrong and you've caused pain, but there are too many variables. Wait, I mean, who knew that there was going to be conflict between in Israel with Gaza, and God forbid that escalates even further. If it does, I mean, the global response to that is going to be horrible. I mean, it's just not even worth thinking about. And I'm hoping that we hear more de-escalation language. It was so weird. If you're on the live with me on Sunday, I spoke about the fact that Lindsey Graham, which is obviously a senator, he was calling for Iran to be their fuel depots to be bombed. And it was interesting hearing him speak this week because he's done a full 180. He's like, we need to have calm. And I'm like, someone's clearly pulled him in a room and said, listen, stop fucking about, play your role. And we need to hear more de-escalation language being used now. But there's a lot of stuff going around on social media at the minute. It's pretty mad. Telling you interest rates could well hit 8%. They dropped it just to get people buying again temporarily. There is someone did message me and say, listen, I bet they're just keeping interest rates low so that everyone spends Christmas, obviously gives a little bit of a Christmas boost. And then in the new year, they come in with new new rate rises. I hate to be that pessimistic, so I hope that they don't. But I truly believe that if interest rates hit 8, there's going to be significant fallout. People won't be able to afford mortgages. Homes are going to be lost. Homes will be repossessed. That will tank the property market, which will be good for first-time buyers. It won't be good for the economy. It won't be good for the banks. Again, all of this is intertwined, right? You can't have damage to property prices without damage to the banks and damage to the wider economy. You can't have that then not affect unemployment numbers. It's such an entangled web. It's mad. I hope that it doesn't get to 8. My sincere hope is that it doesn't, because that would be really, really ugly. Interest rates ideally should be 2% above inflation for banks to run healthy profits. So at some time, that's what it will have to be. 100%. They can't keep them at this rate, and that is 100% spot on. Is it me? Is the picture quality not the best? Let me know, guys. Let me know. This is streaming in full 4K, and I'm looking at my monitor right here, and it looks good to me, because normally I can see it in my screen right here, and it looks pretty solid to me. So let me know if you haven't got good quality. Do you think the Bank of England will... let's have a look. Do you think the Bank of England will put the rate up next month? I don't think they will. From speaking to people in the most people are saying there's about 70% chance that it will remain, that they'll just stay at the 5.25%. We're seeing that in some of the forecasts as well. So I don't think they will, unless something significantly changes between now and then. They're celebrating inflation being steady. Inflation onto inflation. Leave the idiots to lose it all. They are beyond help. Yeah, I mean, look, this is where you get into people, I guess, spinning, right? We saw that last month. We saw that. It dropped from 6.8 to 6.7. And it's like the target was 5.8. Like, don't paint this out to be good news, because it's not really good news. I guess if there is a silver lining, is there really one? Well, the silver lining is that it didn't go up. That's the silver lining, right? If it went up, then, oh my God. I almost think that if inflation went up, their hand would have been forced to next month to increase interest rates. But since it's steady, they can spin it a little bit. It really depends on how you look at the world, mate. I like to be an optimist, but sometimes, like when you follow this kind of stuff, it's just like, you can't. Okay, maybe you guys are saying that the picture quality isn't that great. All right, let's have a look at this. 1 second. I did clean it before I started, so 1 second. Let's just clean this again. And you tell me whether this is that better. I don't think it is. I can't see that it is. Is that better? I don't know. Maybe I can't see that it is. I did clean the lens before we started. I'm using my phone for this, by the way. This is the iPhone 14 camera. So I've got my XT4, which is my DSLR, which I have been using. Was using prior, but this is my phone. So continuity camera into the software. This is clean coming out of the phone right now. So let me know. Is that an improvement? Inflation as much as possible before there's too much. I like the conversation that's going on here, guys. Really, really good. Naeem's in the building. Great to be live with you, Pete. Just want to say we appreciate what you do, whether you do less YouTube or more podcasts, whatever you do, let us users know so we can stay connected and learn more from you. I will let you guys know Sunday that I'm trying to kind of get my head around what this looks like in next year. The reality is there's a lot of stuff happening in the corporate space, and there's a lot of opportunity in the corporate space, and I've been asked to do more in the corporate space, and it's one of the reasons why I haven't been as frequent with videos recently, and that's only going to ramp up. I think I've unearthed something that no one's kind of doing right now in my space in financial services, and to take advantage of it, we need to move quickly. So I'm thinking about how does that plug into the YouTube channel, all the kind of stuff that I'm doing. I still got a massive project that I want to shoot next year, but it needs to be funded. It's a lot of money to fund. So I need to square that off, not necessarily just throw money at something and be out of pocket. So I need to find a way of making it work. So once I know more and once I've figured out what the next steps are, I will let you guys know. But for the moment, it will just be business as usual. Cheers, guys. Thank you. Thanks, Naeem. Okay, cool. Am I at the bottom of this? I am at the bottom of this. Phones to be seem to be compressing the picture. It wouldn't be the phone. It will probably be the software that will be compressing it, or maybe YouTube compressing it as it comes through. That's interesting. Okay. There may be a couple of you that are seeing different quality than others. One more blow on the balloon, then we have a pop. Listen, I hope it doesn't get to the point where, it gets really, really ugly with interest rates and stuff, but only time is going to tell. But at this point in time, I think if I had to wrap this up and kind of summarize it, look, inflation didn't go up. It's at 6.7%. That's probably the silver lining, that it didn't go up. But the flip side to it is, at the end of the day, inflation should be at 2%. Which means that we are way, way above where it actually needs to be. And this isn't a sustainable environment to be in. At some point, we need to get inflation down. Whether they have the tools in the toolkit to continue to be able to push it down without using interest rates is yet going to be seen. We know that wages has again outstripped inflation at this last reading. That is problematic. More money in the system, more people spending, props up the price of goods and services, potentially even pushes them up, which is inflation. So that's going to be an issue. Whether there are any other tools in the toolkit, I guess we're going to have to see. We are definitely going to have to see. But look, interest rates are going to be higher for longer. 5.25 seems to be the ceiling through this quarter and all the way through 2024. Although I wouldn't be surprised if that changes at some point, depending on what happens with inflation. But with that being said, what I have read today, and this is from the IMF, and you take it with a pinch of salt because it's the IMF and they do that. They're saying that we're going to see high interest rates for at least 3 years. So a lot of people have been asking me, are interest rates going to drop? And even at the talk yesterday, are interest rates going to drop from a mortgage point of view? And I'm like, no, mortgages are going to level out about 4 or 5%. That's going to be the new norm. God forbid any further increases happening, because inflation is stubborn, doesn't come down. That's where we are. What the Bank of England are going to do next month, I don't know. The vote right now, as of today, is they'll stick, and that's a 70% chance that they'll stick, I'm being told. Will that come to fruition next month? I don't know. We'll find out when we get there. So that's just kind of like a synopsis of where we are right now. If you did enjoy it, please make sure you smash the like button. It just really, really helps with the YouTube algorithm. There's 76 people on here at the minute. There were like 90 at some point, so people have dropped off. But we've only got 25 likes right now. So it only takes a second. It does a huge favor. And by the way, I just want to say a really, really big thank you as well, because we just crossed over that 43,000 subscriber mark as well. So thank you, and welcome to all of the new ones, new people who have joined. I will see you, maybe not on Sunday, because I'm due to be out on Sunday evening. So maybe we'll do a Q&A next Sunday. But I appreciate you. Enjoy the rest of your evening. Enjoy the rest of the week as well. I'll probably be back again maybe on Friday. I've got a busy week. I'm in London again tomorrow, which is Thursday. And then I've got meetings in Peterborough about a possible app that we're looking to build into next year as well. So maybe on Friday. But I appreciate you guys. Have a good one.
Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer, looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yoked. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coached while I'm researching these stocks. Buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.